Streaming. Okay. Okay. Good morning. Today is the June 26th, and we will continue with chapter 13 that we started yesterday. And so we will move along. And all right, we got up to yesterday the last thing we did was the stockholders' equity. You remember? Okay. Now, the corporation can issue two types of stocks. Okay? It can issue common stock, and the second one is a preferred stock. So why one of them is called the preferred stock?
The ones that they'll be more likely, or ones that they should go after, like stocks they should invest in.
It has a preference over the common in two ways. Has a preference. Do you smell something? Like a candle or something? Or I'm mistaken. Anyway.
My nose started.
Okay. So it has a preference in two ways. Number one, in receiving dividends. And number two, in receiving equity in case of liquidation. The preferred shareholders get their equity first if there is a liquidation of the business, and they receive dividends first. All right? So that's why it's called preferred stock. And then common stock, this is the basic form of stock. They have voting rights. The preferred stock does not have voting rights. Yes. And usually the common stock provide owners with the means of controlling the corporation. See, because they are the voters. They are the one who vote on issues. Therefore, they have the controlling mechanism. The common stock is also called residual equity. All right? Because the claims of all creditors, and usually those of preferred stockholders, rank ahead of the claim of common stockholders. So once the equity of the preferred is given, so the rest belong to common stock. All right? Now, yesterday, we explained the meaning of authorized, issued, and outstanding. Did you get the assignment that you got yesterday? The bonus points?
No, I did not.
Okay. It's all right. You can do it another time, yeah. So, we know the authorized are when you first apply for the incorporation, yeah. Is the maximum number of shares that a corporation's charter allows to issue. Remember yesterday we said the 100,000 shares you were authorized, but 60,000 were only issued. And then, so the issued are those that are sold. The certificates are printed and sold to the public. All right? And then the outstanding shares are the shares that are issued and circulating in the hands of the public. So a share cannot be outstanding unless it is authorized and issued. Now, can the issued be can it be authorized, issued, and outstanding? The issued? No. It can be issued but not outstanding. Which shares are those that are issued but not circulating in the hands of the public? Treasury shares, yeah. Those treasury shares are authorized and issued, but they are not outstanding. All right? Now the dividends that is distributed to the corporation. Remember we said that the preferred shareholders get their shares first. All right, and there are two types of preferred dividends. Okay, even though this one says non-cumulative preferred stock and a cumulative preferred stock, but it has to do with the dividends. If it's a cumulative first, the portion of the dividends that belongs to the preferred shareholders must be paid. If it's cumulative, let's say if this year the preferred shareholder is supposed to get $10,000 of dividends, but there's only 8 available, that means the other 2 must be given next time. All right, so that's called dividends in arrear. If it is non-cumulative, they only get what's available. Even if they're supposed to get 10 and there's only 8 available, that's all what they get. There is no dividends in arrear. But the cumulative, there is a dividends in arrear. And we're going to explain that in a minute. Yeah. All right, before we go to the next slide, so let's explain this concept. Let me go to the Word or Excel. All right, and let's pick one. So let's assume, all right, that corporation X, okay, declared dividends as following. Declared dividends as following. Dividends as following. Okay, so year 1, first year, there was a $2,000. Let's say, for the sake of explanation, let's say there was $100. $100. First year. Second year, there was $150. Third year, there was $175. Okay. Let's assume, bless you. You have homework for me, a bunch, and exam 1. And now give me exam 1. I didn't give you exam 2, the final. Let me give you a copy for exam 2. Now we are on chapter 13, which is the first chapter of accounting 2.
All right.
This is the final exam. Have you registered for accounting 2? You need to go to the registrar's office after this class and register for it.
Yes,
okay? Because we need at least 5.
all right.
Yeah. And this one is more practical. You shouldn't have missed yesterday.
Yes, sir.
It's a practical. Have you noticed that this one is more practical than accounting 1?
Oh, yeah.
Yeah, accounting 1 is kind of basics, but this one is related to corporation. Yeah. But anyway, so let's assume that corporation X declared dividends as following: year 1, $100; year 2, let me just do this and put the dollar sign. So, all right, let's assume that preferred shareholders. Let's say it's a cumulative dividends. All right, cumulative dividends, and the shareholders supposed to get, the preferred shareholders, supposed to get $150 a year. All right, $150 per year. Now, how do we know how much preferred shareholders should get dividends a year? How do we know that? There's a formula for that. So you got to go to preferred shares outstanding, preferred shares outstanding times par value per share times par value per share times the percentage given times the percentage given in the stockholders' equity statement, in the stockholders equity statement. That gives us preferred dividends. So, as you can see, the preferred dividends is equal to preferred shares outstanding times par value per share times percentage given in the stockholders' equity, and will give us the preferred dividends. All right? So, let's see if we can find an example. Let's go to chapter 13 and see if we can find an example, and I'll show you what we are talking about. Okay, look on page 525. Page 525. You see this example? Contributed capital, preferred stock is 4%, cumulative convertible, $20 par value, 50,000 shares authorized, issued and outstanding. So, if you use this formula on the example, okay, example, let me go back, F2, I want to go down, that's fine, we had the formula, correct? Okay, for the example page 525, correct? Okay, page 525. How much is the preferred dividend using the formula? The formula we just written down. So how many preferred shares outstanding? 50,000, correct? Times
the par value per share,
which is
$1.
No, what are you looking at?
Oh wait, I'm looking at the second one below it. It's $20 par value.
There you go. Times the 20, that's correct. Times
The percentage given in the stockholders' equity.
what percentage? What is the percentage?
4%.
Yes, 4%. times 4%. And that's equal, find that for me. Let me go and get some water while you are getting that. I'll be back in a second.
Huh? Alright.
Okay. How much was it?
40,000.
40,000.
40. That is the dividends that preferred shareholders must get every year. It's cumulative. Now, what kind is it, first of all? Can you tell what kind? Is it cumulative or non-cumulative?
Say cumulative.
Cumulative, yeah. All right. So now, when you look, remember when you look at the stockholders' equity, all right. And, remember yesterday we said how many sections are in it?
Gets 4, 3.
They are contributed capital,
Oh yeah, contributed capital.
retained earnings, treasury stock, yes. And the contributed capital is made up of Mr. Bailey, Brother Bailey, you haven't been studying preferred stock and the par value and the additional capital. Common stock, the par value and the additional capital, and you add those together, that give you the contributed capital. All right. So look at this. Does this match this example? Does that match the components of stockholders' equity? What are you looking at?
I'm looking at the very beginning. Just that.
No, I'm looking at
I
525.
know that, but I'm just saying. Get back at
Does that match? We have preferred stock and we have common stock, correct?
Yes, sir.
We have additional paid-in capital. It looks like the preferred stock does not have a additional capital, but the common stock has additional capital. You see that?
Yeah.
And there is another paid-in capital that belongs to treasury shares. So we have two. Looks like they have treasury shares in this example. All right. You got to know the structure of the stockholders' equity. You got to know it, yeah. Remember the formula for the capital? Beginning balance plus net income plus additional investment minus withdrawals.
Equals
If you remember that,
Yes, sir.
that was easy to remember, correct? But you need to remember this one too now. The capital is different now. We call it stockholders' equity. All right. So going back to our example, let's assume that this corporation X declared $100 first year, $150 second year, and $175, and they are supposed to get $150 a year. And we're going to assume this is cumulative. We're going to assume it is cumulative. So the first year, if you go back over here, all right. So let me put a preferred stock, and common stock. So the preferred stock, how much they're supposed to get out of this $100?
$150.
They're supposed to get 150, but there is only
$100.
100 available.
So they gonna have to pay the extra the next year.
Yes, sir. So the whole 100 should go to whom?
The preferred stock.
Preferred, and the common gets 0. Now we have $50 in arrear, correct? $50 in arrear. In arrear. You understand?
Yes, sir.
All right. So the next year, there are $150. So how do we assign these to preferred and common stock, the 150?
You still got to get the preferred stock the whole 150 because you still
Yes,
owe
sir.
them. And you
No, wait a minute. Now,
you
let's,
still owe them 50 too.
they are entitled for 150 plus the 50 before,
Well,
correct? So they're going to get all the 150 and 0, and there's still 50 in arrear. Again, 50 in arrear. Not in the rear, arrear. All right, in the back. All right, next year, year 3, there are $175. They are entitled for their 150 plus 50 from the previous year. So that's a total of 225. Correct? No, wait a minute. 150
nah,
this year plus 50 from last year.
it's
That's
200.
200.
So you get
Oh, sorry. But there is only
175.
175.
And they're gonna be 25 in there.
25 in arrear, yes. 0 for common, now 25 in arrear. So let's say year 4, there are $250 declared dividends.
Okay.
So we're going to get the 150 that they're entitled to plus the 25 in arrear, so it's 175, and the rest goes to
The common stock.
which is
75.
75. For the first time, the common shareholders get dividends
After 4 years.
after fourth year. But this is just an arbitrary. I'm just trying to explain the concept. Yeah. If the stock is non-cumulative, then there is no dividends in arrear. The whole 100 goes to the preferred. There is no dividends in arrear. Second year, the whole 150 goes to them and 0. Third year, 150, 25. 150, 25.
Nah, that'd be more than that.
Yeah?
That'd be 100 for the common stock for the 4th year.
No. Ah, the fourth year, you're right. Yes, sir. Yeah, you're right. So, now let's go back to our slides.
Excuse me.
Bless you.
Thank you.
So you see what non-cumulative preferred stock and cumulative. And so if the stock is non-cumulative preferred stock and the board of directors, bless you, the board of directors fails to declare dividends in any year, the company is under no obligation to make up the missed dividends in the future years. There is no dividends in every year. And if it is cumulative, yes, there is a dividends in every year. All right. With that in mind, let's move along. Now, preferred stocks can be, some of their characteristics, they can be convertible and they can be callable. Convertible means that you can convert them into common stock. Why would you want to convert your preferred stocks into common stock? Why? Why do you think you want to convert your preferred stock into common stock?
So you could have more decision.
Make more money.
How?
You sell it.
No, you convert them.
Oh,
You know,
well, yeah, you convert
you
it.
buy each. Well, you could say you sell them and you buy, or you immediately convert them into when the common prices are good, prices they are okay, or even when they are down, you want to take advantage. You buy more common stock. Yeah.
So you get
Right.
a bigger
Mhm.
vote. Like
Yeah.
you get more like power over the company.
So, owners of convertible preferred stock can exchange their shares of preferred stock for a share of common stock at a ratio stated in the preferred stock contract. So, but of course, you can, you have to follow the articles of incorporation, and that condition is listed in that, where it says you can convert 142 or 143 like that. Yeah. And in the callable, the corporation can call those shares back. The issuing corporation has the right to ask for shares back.
Oh yeah.
Why won't do that? We're going to see that in a minute. Yeah. That is, the issuing corporation can redeem it at price stated in the preferred stock contract. The prospectus. Have you ever heard of the prospectus? Before you buy shares of stocks, read the prospectus. It's equivalent to the articles of incorporation. Yeah. Okay. So, when the preferred stock is called and surrendered, the stockholder is entitled to, you get the par value of the stock. You are entitled for the premium. Like, for example, if the common shares are if the common shares are equal to $20 a share, and they're giving you $30 a share, they buy it with you with 30, so you're entitled to the additional fund plus the par value. Okay, and then you are also entitled for any dividends in arrear. If there is a dividend when you surrender your share, if there is a dividend arrear due, you didn't get it, you're supposed to get it. Yeah. The current period dividends, also you are entitled for the current year dividends. Yeah. It depends on, let's say, if it was called back in July, so that means you are entitled for dividends from January to July. Okay. See, remember yesterday we said the par value is an arbitrary base, an arbitrary value.
Yeah.
You just amount assigned to each share of equity.
Mm-hmm.
And also, shares can be no par. Can be no par, but still have a value. Okay, still have a value, but at no par. It does not have a no par. It's not in the contract, in the article of corporation. It doesn't say, it just say no par, or just say stated value. Stated value instead of saying par value, stated value of $10, $5, $3. Why? There is a difference between when we say par or no par. What's the difference? When you say stated value or has a par value. Both still have, the shares still have a value. But one says par and one says no par or stated value. The difference is in the minimum legal capital. Did you hear that yesterday? Did we mention that yesterday?
Yeah, because like you said, when you have the minimum, that's where the par is there. So like you still 60,000 stocks at $2, you have to have a minimum of $120,000.
See, when it says par value, I mean you have to have the minimum legal capital, and it's equal to outstanding shares times the par value. That's the minimum legal capital. But if it is no par, you don't have to keep the whole minimum legal capital. That's the difference between the two. You don't have to keep the minimum legal capital. Some states allow that, and some states do not allow it. So here is, if you want an extra credit, in addition to yesterday's, state or list the states that allow no par value shares. That allows the issuance of, list the states that allow the issuance of no par value shares. That's an extra credit. So you have two now, two assignments. Number one, name the government office. Name the government office that authorizes the issue of stocks.
Now you said which government office corporators file
Yeah,
to start a corporation.
It's the same.
In the state of Texas.
Yeah, in the state of Texas.
Name the government office. Name the government office.
It was number 2. This for account 2, right?
Number two, yeah.
When corporators file when to start a corporation.
What was number 2?
Huh?
What was number 2?
Number two, list the states, list the states that allow
Start a corporation.
the issuance of no par,
You said the insurance? Like
the issuance,
issue?
yeah, issuance. What's the germ of issue? Issuance, right?
Yeah, insurance.
Not insurance, issuance,
Issue.
Like issue, like
issue.
issue,
Oh, issue. Okay.
Yeah.
issue.
Issuance.
That's issue.
Yeah, issuance. Name or list the states that allow the issuance of no par. I'm going to tell Dr. Johnson about you. Now, I asked you yesterday to stand in the front and you refused.
I could have around with us.
No, I'm going to tell Dr. Johnson about that.
I was trying to get home all the other day. It's an issue, list of states that allow the
The issuance,
issuance.
yes, of no par, NOPAR, 2 words,
Yeah, I got it.
no par value shares. Yeah. All right. Okay. State laws, look at this. State laws often require corporation to place a stated value on each share of stock they issue. The stated value can be any value set by the board unless the state specifies a minimum amount, which is sometimes the case. Okay. Most states require that all or part of proceeds from a corporation's issuance of no par stock be designated as legal capital, which cannot be used unless the corporation is liquidated. So the minimum legal capital cannot be touched until
The company's been liquidated.
yes. Okay. With that in mind, let's move along. Now we come to the treasury stock. The treasury stock is what? Is when the corporation, the issuing company, reacquires back those shares. They are no longer outstanding, but they are issued. They are authorized, issued, but not outstanding. So treasury stock is a stock that the issuing company has reacquired, usually by purchasing shares on the open market. So they just go and buy back the shares. They give some incentives, probably, to the shareholders to buy it from them. See, in the previous days, in the old days, it was a lot easier to buy the shares back from shareholders, because you know how they are. But today is not that easy.
Why not?
Today, because you have owners of shares all around the world. You have people who own shares in China, in the Middle East, in Russia, in Europe. It's kind of difficult to know who. But most of, if you noticed, there is a recent merger, guys, between two corporations. Recent merger. Come on, Brother Bailey. What is that merger? I'll help you. Two communication companies.
AT&T.
Time Warner. Is it Time Warner's or?
No, AT&T. No.
I have it. I have a message from AT&T. I don't know if I can get that message back. Okay. I had a message, a free message. It's, I think it's Time Warner, probably. Or it's another communication company. Messages. Let me put 18. Oh, here it is. I got it.
It's Time Warner.
I got it. AT&T free message. Our records in the canal. AT&T, Warner Media. Warner. AT&T free message. Warner Media, formerly Time Warner, has joined our family. AT&T companies share your information with each other. With our merger, Warner Media is now included. This means great deals and on. Yeah. So is Time Warner now is part of AT&T. See, the merger is done with negotiation between the two. It's not hostile takeover.
Yeah, I don't know. Time Warner was. I don't think.
No, it's not a hostile takeover yet.
I think they was doing. I mean, it was a hostile takeover, but Time Warner needed that merger.
Yeah, probably because they were. Yeah. So, why would a company want to buy back its own stocks? For these reasons that you see here, to distribute to employees through stock options.
That's what Amazon does.
Yeah. What is a stock option?
Like you have an option to get the stock.
How?
Like they want to
Ooh,
Take
is this a
some.
question? Is it like you work for so long, you get a certain percentage in a company like stock wise? Cause I know when I was working at BJ's restaurant, the managers, they'll get like, once you're a certain manager, you get a certain percentage of the company.
It works like this. Now is also given not just to managers and not just to management. Some loyal employees also have been working, so they give you a certain number of shares to buy at a specific price in the future. Let's say that they give you 100 shares and you have 3 years to do transaction with these 100 shares. Let's say today the price of the share is $20. You get your 100 shares, and in the future, if the price of the share went up to $35, you would have the right to buy the shares for $20, even though they're worth $35. You can buy them for $20, and then you made an extra. You paid only $20 for shares that were $15. So you made $35. So you made $15. You earned, yeah. So that's the stock option, yeah. You have the option to exercise it in the future. So you have the option to buy a future share at a set price now. Okay, yeah, that's what I'm saying. So whatever the price in the future, you pay only the set price now for it, yeah. Okay, so to distribute through stock option, to maintain a favorable market for its stock. Also, they don't want to have too many shares in the hands of so many people, yeah. So the less probably, I'm not going to say the less is the better, but the less, the higher the earnings per share. The less. So if you have a 50 shares outstanding and the earnings per share is the earnings are $100, so you divide 100 by 50, you get 2, correct? But if there are 20 shares, then you divide 100 by 20, you get 50 by 5. You get more. See, the less the outstanding, the better the earnings per share. Yeah, that's what probably is. Yeah. Oh, that's the third one here, to increase its earnings per share. That's the third one. Yeah. So the second one, to maintain a favorable market, they just want to keep the price at specific, amounts. And then to have additional shares of stock available for purchasing other companies. That's probably for takeover, yeah. Purchasing other companies, and to prevent hostile takeover. So if you have the corporation has over 51% of the share, nobody can take over it, yeah. Nobody can take over it. All right. So these are the reasons, some of the reasons why the corporations reacquire back their shares. Now, accounting for dividends. There are 2 types of dividends, by the way. There is cash dividends and stock dividends. Okay, there is cash dividends and there is stock dividends. And instead of getting cash as dividends, you get extra shares of stocks. Yeah. But now, as far as cash dividends, now remember, like we said earlier, the corporation is not obligated to pay dividends. I'm sorry, they're not obligated, but they should, in order to give the shareholders some kind of confidence. Okay. Although corporation may have sufficient cash and retained earnings to pay a dividend, its board of directors may not do so for several reasons. The corporation may need the cash for expansion. It may want to improve its overall financial position by liquidating debt. That means if they have the cash, well, they may give you stock dividends instead of cash dividends. If they give you stock dividend, no cash is getting out of the business. Yeah. But so they may need the cash for these reasons, or may be facing major uncertainties such as pending lawsuits, strike, or a projected decline in the economy. So they have enough cash on hand. They have enough liquidity. Yeah. All right. If a corporation declares dividends that exceeds retained earnings, now where is the dividends paid out from? Usually it's given out of income. Remember, when the corporation make income, they give some of it as dividends, and the rest goes to retained earnings.
Back into the company.
Yeah, back into the company. What happens if there is a dividends, there is no income, and not enough in retained earnings to give dividends?
Well, you had to do.
Now remember, once it's declared, it has to be paid. Once the dividends is declared, it has to be paid. Yeah.
Cumulative, not cumulative.
Now we're not talking about cumulative here. There's no.
I'm talking about that depending on it's like.
If there is no enough.
Can we give them what we got, or
yes.
Owe them, or do we have to still give what we got and owe them still?
There is no arrear here. If there is no enough, it has to be paid. You have to sell some assets. That's called liquidating dividends. If the dividends declared is more than the income, or you don't have enough retained earnings, then you have to sell some assets.
Taking a loss.
Yeah. All right. There are 3 dates associated with dividends. 3 dates associated. There's the declaration date, date of records, and the payment date. All right? 3 days associated with dividends. Declaration date. On the declaration date, you must do a journal entry. You must do a journal entry.
Oh yeah.
Dividends declared, dividends payable. Dividends declared, credit, dividends payable. On the date of records, there is no journal entry. Yeah, on the date of records, the corporation is still trying to figure out, that's the date of records, yeah. Who is going to get the dividends, what kind of dividends, who is not getting, like that, yeah. It's only a memorandum. Okay, they will have to issue a memorandum only. And the payment date, yes, there is a journal entry. That's when they actually pay the dividends. That means you have to credit cash. There's a payment. All right. We're going to do some accounting examples. All of those things, yeah. We're going to come to the accounting in a little bit, yeah. Is the, like we said earlier, the second form of dividend is a stock dividends. So like we said, instead of giving a cash dividend because they need the cash, they will give stock dividends. Remember, guys, when they had the spill in Louisiana, is it Louisiana?
Mm-hmm.
The oil spill?
The Gulf Coast.
Yes. At that time, I think the, is it Shell?
Nah, it was BP.
I'll be British, okay.
Mm-hmm.
BP, they had enough, they could have stopped it, they say, if they brought their heavy equipment. But they didn't stop it for a while, yeah. But they still have, they had lots of money. So they gave their shareholders stock dividends to make them feel a little bit more comfortable, yeah.
To reassure them.
To reassure them, yeah. So, a stock dividend is a proportional distribution of shares among corporations' stockholders. Unlike cash dividend, stock dividend involves no distribution of assets. That means nothing is going out of that business. You take it out of retained earnings and you put it in contribution capital. So the total stockholders' equity is still the same. The assets are still the same. They are not affected because no cash is given out yet. So if there is a cash given out, then the assets will go down and the contributed capital and the retained earnings will go down. Yeah. Okay. Mm-hmm. So a board of directors may declare stock dividends for the following reasons. So there are reasons for giving stock dividends: to give stockholders some evidence of the company's success without affecting working capital. So what do you remember working capital? In accounting 1?
What do you say?
Working capital, WC. Current assets minus current liabilities. Right, that's working capital. So they want a healthy working capital. That's maybe one of the reasons why they give stock dividends. All right, and also to reduce stock market price by increasing the number of shares outstanding. So the more shares outstanding, stock market price may go down. Because see, if you give stocks dividends, I mean you have more common stock, more shares outstanding. All right, and to make non-taxable distribution to stockholders, if you give the stockholders cash dividends, then they have to pay for it, to pay taxes on it. But if they get thank you. If they give stock dividends, it's non-taxable to the shareholders. And then to increase the company's permanent capital by transferring an amount from retained earnings to contributed capital, like what we said earlier. All right. So these are the reasons why a corporation give stock dividends instead of cash dividends. There is also stock split. Businesses can do, or corporations can do stock split. They can split each share into 2 or 3. So if you have one share and the corporation decided to split it into 3, so you will have now 3 shares. But see, it's like if you have a dime and you put the dime divided into 2 nickels, still 10 cents, correct? Or if you change the dime into 10 cents, still 10 cents. So the par value of the share has to change now also. It's not going to stay the same. So if you have a par value of $6 and you split that into 2, then the par value become $3. Yeah. Okay. Now, why would a company want to do stock split? For these reasons here. To lower its market price per share, so people can afford to buy more shares, yeah. Thereby increase the demand and volume of trading for its stocks at this low price. Sometimes, what's the market value for the Apple? Is it in the hundreds?
Apple.
Can you look it up there?
You said Apple.
Yeah. Apple market price per share.
$184.27.
$184.
That's the
So it's not easy to buy.
That's just for one, right?
Yeah. So if it's split into
Yeah, 184.24 USD. This is what I'm looking at right here, Doc. Look at the overview. I typed in a market price per share.
that's it, 184. It has an increase of
So that's how much
$2. It was 82 yesterday.
So that's how much it's gonna cost to buy into the stock?
Yes. If you want to buy one right now, Apple, but you have to pay commission. You have to pay fee. If you go online to buy a share, you pay more than 184.38. You would have to pay a fee for the transaction.
So now we're on 184. So you can I'm gonna dang near pay like what 300?
Maybe
What's
they
going on
charge
with
you.
Yahoo?
Maybe charge you $10-15 for that transaction.
It's from with Yahoo.
184.
It got 0.
What? What is Yahoo?
Right here.
Okay, cool.
No. That means it's still the same from yesterday. There is no increase or decrease.
Okay.
Yeah, still the same. Yeah.
Google is expensive.
And number 2, to signal to the market its success in achieving its operating goals. So this is a sign of success when you do the stock split. Yeah. Now, statement of stockholders' equity. Yesterday we went over that. We showed you the skeleton of it. Yeah. All right. And if you go to yesterday's lecture, it's recorded, and you will see it. Yeah.
I'm gonna go.
Yeah.
I'm gonna go to all the lectures I
Okay. They are luckily they have been recorded. Yeah.
missed.
Yeah, that's good.
Yeah.
So,
Okay. Let's see. I think for the book value, maybe better we do an example. Hopefully, when we do the accounting. So I think this is the last thing, dividends yield by dividing the dividends per share by the market price. These are some of the evaluations. Here is stock options. All right. What we're going to do, by the grace of God, on tomorrow, is we're going to start on page 501. Okay, and we're going to go on page 501, and we're going to do all of these examples. All right. So from page 500, let's say page 500 to page 500 and yes, 516.
Oh, 5, 6.
516, yeah.
Oh,
We're going to go over those examples. So,
Oh, you got a staple
those pages. Yeah.
Two more.
I need homework now.
I got 2 more pieces of homework. 6 and 10.
All right. Let me see those now.
6 and 10.
6 and 10.
Yes, sir.
This one's 6 and this one is 10. Where does it
Yeah.
say 10?
Oh, let me underline it again.
Okay. You got
That's 6, 7. I got 8 on
Six,
the way. I'm about to be done with all my.
7,
Here you go.
6 and 7 only.
Mm-hmm.
Okay.
Hold on, there.
Well, you
What's
still
up?
didn't put 10 in it. Yeah, here.
I'm not. I just raised my.
I'm a Muslim. I was gonna say Jesus.
My bad. I ain't mean to. I ain't even mentioned to you.
Okay.
Oh, yeah. Okay,
Yeah, don't forget to go to the.
Yeah, register
Yeah.
off style. I ain't forget. I'm
Yeah.
about to go.
So,
I saw Jerry.
You-
so that will give
What
us a
other,
total of 4. We still need at least one
No,
or two
I
more.
mean, Ledbetter, I think he's supposed to come back, so he need to go ahead and register. Gilbert, I don't think he
Did you
registered.
call him? Ledbetter?
I texted him last night.
Oh, you did?
Yes, sir.
Okay.
He was in Mississippi, so he.
Ooh, he
I
need-
got back from Houston yesterday. That's why I'm like 3
Call
in the
him and
morning.
tell
That's
him
why I'm
Ali
busy.
says if you want to make it, you need to turn in the assignments. Yeah. Tell him Ali said, if you want to make it, just give me the assignments. And I'll go and fix your bonus, yeah. And by the end of the day, you will see what you got here.
Yes, sir.
So C is okay with you, huh?
No. I haven't got to see I haven't got to see in 2 years yet. Though.
C minus?
Oh,
So I'll give you a C plus. How about that?
drop out.
All right. Let me stop.